Hello and welcome to the Retire While You Work podcast. I'm Miles Zuger, a wealth advisor here at Adams Wealth Partners, joined by Carson Odom, another wealth advisor here on the team, and Jeri Anne, who is our director of operations. You're a repeat listener. I think you probably know who we are, but always good to introduce ourselves. And today, what we wanted to talk about was inflation and how it affects finances in general, investments, really just anything when it comes to inflation and affecting your finances. So I think this is something that obviously over the course of the last, 3, 4 years has been big in conversation. And I feel like people are still continuing to feel the effects of inflation. I know we have a few charts to illustrate that for later on, but even though inflation is not where it was, say, in 2022, it's still going higher, just not at the same rate. I think a lot of times people get confused by those numbers and what exactly they mean. So we just want to talk a little bit about that today and how it affects finances, but I'll just maybe raise a question to you both. Where do you feel like overall you feel inflation the most just in daily life?
That's a good question.
Um, I'll answer that quickly because I feel it in food, like groceries and eating out, food delivery, any of that. And one reason, so we started out a family of five that we were buying for, and then eventually they each went off to college. Then we were a family of four, and then we were down to three. Now we're at two. And my bills for food have not gone down. They're literally the same as they were when we had a family of five.
I would agree with that. I feel like there was a time period where it was like way cheaper to eat inside. Like maybe if you wanted to make something inside and you had to go get a few things, it would cost like, I don't know, $20. Now I
Yeah.
feel like if you have like random spices and stuff you don't have, like if you're making like a meal that you don't often make, I mean, it's as expensive to cook at home as it would have been just to go out and eat for, I'll say two
Mhm.
people, like to go out and eat for two people. I guess you maybe don't have the leftovers, but like it's still a very similar cost to whether you're eating in or eating out, it feels like, depending on what
Yeah.
you're making, obviously, or where you're eating.
And on top of that, you throw a cocktail into there. Since when is it okay to charge like $20 for a cocktail that has like 3 ounces of liquid in it? Like
Yeah.
that's, I think maybe a little exaggerated here in Nashville, but that's just out of this world. I feel it. I mean, I think like anybody, but food is just insane. Just like you said, especially with both my girls now, eating just everything that we're eating, being school age, is just outrageously expensive. And to go on a point that you made earlier, Miles, that if inflation has not gone away, it is still a thing. It's the fact that inflation is no longer increasing at the pace with which it was previously. We're going through a period of disinflation, not deflation. Deflation is prices actually decreasing year over year. Disinflation is when inflation is going up, but just not as much. So to illustrate what's going on, I'm sharing a graph of kind of the U.S. inflation rate since the year 2000. Since 2000, the inflation rate here in the U.S. is right at about 2.58%. We're currently at the latest inflation reading at about a pretty much a 2.9% year over year. So essentially taking all the prices of the goods, if we look exactly 12 months ago, prices as a whole are 2.9% higher. Now, if you look at the peak of 2022, we were at a point where inflation got as high as over 9%. So almost a tenth of every dollar is gone, wiped out a year later, that your purchasing power has decreased that much. Which
And that's
this
really only on, like, that excludes food and oil and gas in there. Is that correct?
hmm, uh,
Do you
what
know if
is
this one does? Because I know that's a couple things that are left out of like the big inflation
Yeah, right.
readings
And
that we see. Is it leave like to the things we're talking about that you feel it the most? It leaves out, and a lot of times it leaves out the cost
food
of
and
food
energy?
and the okay, food and energy.
Yep.
This is excluded or included there.
This is CPI excluded.
Okay. So this doesn't have food, which to our, you could argue that's probably more like 20, 30, 40% higher. I mean, if you truly look at what you're spending on things, I think Carson actually has another chart to share on like the cost of McDonald's food to where in a short period of time, it's like basically doubled. Or this chart here that also shows things back to 2000. I'll let him touch on this one.
Yeah, so that, going off that same talk that, average annual inflation's been 2.5%. What does that mean over the course of 20, 24 years? It means that the purchasing power of your dollar has decreased by 75%. That a dollar in the year 2000 has gone down in value cumulatively to a point where now, on average, food and beverages and housing is up 80% compared to what it was in the year 2000. And then this just shows the vast difference in the types of things and how they either inflate or deflate. For example, we know that healthcare and college are some of the top two categories for items that have increased in price the most. And the things that we can think of that have decreased in price, for example, at the bottom of the list is computer software and TVs. And we know that, to get a nice flat screen TV way back when was a few $1,000s. Now you could get honestly, a huge flat smart screen TV. I don't know, a couple $100.
600
Yeah.
for a good one.
Yeah, a cheap one, probably $200-$300
Yeah.
on Amazon. It's so much more affordable, and kind of the
So,
necessities are going up in cost.
so, and the ones up at the top are things that are a lot more expensive, right? And
That's right.
so obviously college tuition and fees has skyrocketed. One thing I kind of disagree with there, just from experience, college textbooks used to be so expensive. Like even back when I was in school, I would have to have like $500-$600.
Yeah.
When my oldest started, she was like, it was $900 for books. But now that my youngest is there, it's like $200 because it's all like electronic. Now it's like electronic books and stuff. They don't actually have to go get those big expensive books, but
Right.
everything else on there, yeah, it's crazy.
It is. And the last one, just to kind of hit home about food inflation, here is a chart of McDonald's pricing, literally just to 10 years ago. 2014 cost compared to 2024 cost. In my mind growing up, I feel like it was always, you go to Wendy's and McDonald's, pick up a meal with your parents, you can get a meal for $5. Like $5 was all you needed in order to get a solid meal. And now, like, you could get a couple, or a McChicken, a McDouble, and a medium fries. There you go. You're still under $4 before tax back in 2014. But now, look at that. A quarter pounder with cheese meal. You're going to walk away from McDonald's with paying $15 just for a easy meal.
All I'll say about that is that double quarter pounder with cheese and fresh fries is worth all $11.99 in my opinion.
Depends on.
Well, I was just gonna say, and then you put Chick-fil-A in the mix, but because like we just got Chick-fil-A for lunch, and Carson's was like almost $12 for just himself. So it's like
it was a sandwich, fry, and a drink. Yep.
Yeah.
I have vivid memories back in, early, kind of maybe late 2000s or 2010 ish. I was going to Chick-fil-A with my friends like every single week, that high school, college time, just every single week, 2 or 3 times a week. I was just constantly going to Chick-fil-A, and I'd buy a number one, and it was like $5.20 after tax for a number one chicken sandwich, fry, and a drink. And it was just over $5. And now it is probably double that, just about.
Yeah.
So all that to say, all these statistics, inflation is extremely real, and it is the devaluing of the dollar, and it's the devaluing of your ability to pay for goods. A dollar, yesterday even is worth less than a dollar or your dollar today is worth less than a dollar yesterday. And you grow that scale on a decade by decade, a dollar 30 years ago, my goodness, you could buy you so much more than it does today. So really, overarching the question that we can kind of ask and talk about amongst ourselves is what do you do with that information? Yes, inflation's real. It's probably never going to go away. The long-term trend, I think, since really the past 100 years in the US, inflation has averaged about 3%. So yes, the Fed has that target 2%, but really 3% is the average. What do you do about that? Do you do anything? What should this encourage you to do?
Well, and before we go there, the other thing I was thinking, and that doesn't even include like service inflation, right? What you're paying for hotel rooms and flights and I don't know, it seems like you have to tip everybody now for anything. And so I feel like that's like even more inflated than just our regular inflation. I don't know if y'all agree with that.
regular CPI includes food or clothing, transportation, medical care, recreation. So there's probably some service data in there. It'd be interesting to see if we have
Yeah.
exact list of what all CPI includes. But yes, you're right. Yeah. So, from an action item, like inflation's here, what do you do about it, Miles?
Good question. I mean, I think that's where like, you know, we've had a lot of conversations. I feel like with inflation and interest rates both up, there's been people who have loved getting, we'll call it 4 to 5% on cash in the bank. It's felt really good. But then when you see, I mean, even at the peak, let's say interest rate, you're able to get 5% on your money. Well, if inflation's 9%, you're still losing 4% on that money from a purchasing power perspective. So I think that's where we always want to stress the importance of having an emergency fund for emergencies, obviously, and liquidity and cash needs. But I think that's where you need to be investing. You need to be saving into 401ks, IRAs, retirement accounts, just general investment accounts so that you can outpace inflation. Because when it's at 9%, again, cash feels great. Maybe we haven't seen that in a couple decades, but from a purchasing power perspective, let's just hypothetically say it stayed at those levels. Let's just say inflation stayed at 9 and you stayed at 5% in your cash. Feels good, but over a 10, 20, 30-year period, that does not feel so good. So I think
The
you need
real
to,
return is
yeah,
negative.
is negative. And so you need to think about what are some things you can do to outpace that. And it comes
Well,
back to, I think, just investing in good quality companies, and stocks and other bonds and real estate, et cetera, as a whole and well-rounded financial plan to be able to outpace that.
and get it going like automatically where you don't have to look at back, oh my gosh, my bills are a certain amount this month. Get used to that amount coming out. And then even as inflation grows, if you're still just putting that amount away, that's helpful. But if you can up that, once a year, or, we always say if you get a raise, up your 401k by 1% or something like that, you can do that, with just your regular investments too, outside of 401ks and IRAs, but, and in your savings account. Just make sure you're paying yourself first.
Yeah. And because even if like cost of living raises, like let's just talk wages for a second too. Like cost of living wages, if you're just, inflation's going up, let's say 5% and you're getting a 5% raise, yeah, you're able to keep pace, but you also need to try and outpace that. So maybe it's, trying to get promoted or looking outside your company for another job so you can earn more money. That's also another way to get ahead of inflation or further your education so you can do that, so you can outpace as well by earning more. That can be a little bit harder depending on what your job is and what you've been doing, but I think that's important also, from that perspective.
I had to get my book of overall inflation adjusted market returns, just because I feel like this is a really, really interesting chart based on your time period, how the overall market can perform and inflation adjusted. And if you look back and go through, I think the past 97, 98 years since 1926, inflation adjusted market performance has been right at about 7%. So you think that is after inflation. So gross is probably in addition to that. You take out inflation and you're still increasing your purchasing power over time on average annually. Obviously, there's fluctuations in the market. There's going to be years where the market's up, years where the market's down, or extended periods of like the last decade, 2000 to 2010, where the market's overall annualized rate of return is negative. However, it just goes to show that the overall stock market can be a really good investment to make to outpace inflation over time. There are years where it loses, but over time, the stock market has proven time and time again that it's one of the best ways to outpace inflation. We can look at, I think I can probably pull up inflation adjusted 1 month. Yes, this is 1 month US Treasury bills, inflation adjusted. Look at all that red, where it is essentially a negative rate of return over periods of 50 years, where safe money ends up realizing you a real negative rate of return. Just because, like you said, Miles, it feels amazing, especially in today's day and age. It feels amazing to have your bank account paying you 5%. But think about that in a large scale. What's the opportunity cost? I think there's a stat out there that says ever since the Fed has hit their 5% rate, if you would have stuck all your money in cash at 5%, the stock market's 35% higher than it was when it was as soon as the Fed funds rate hit 5%. Don't quote me on that. It's probably a little bit different than that, but it's just opportunity cost. It feels
Well,
good, but at what cost?
what about if people are still scared to do more than like a money market? They're afraid of the stock market right now, except I mean bonds. Aren't bonds another good place they could put their money right now based on what they're paying out?
Yeah.
Yeah, they are. I mean, I think it all comes back to just having that balance in a financial plan to be able to, again, I feel like we always bring it back to the three buckets, but I think it's easy to kind of think about it as a plan. It's always smart to have short-term money, kind of that midterm money, maybe 3 to 5 years and beyond, and then retirement accounts. And so if you're working with us or another, you know, good financial planner, I think they should be taking all that into account as part of a well-rounded financial plan. And what are the pieces to your plan that, what is that 3 to 6, 12-month bucket? And what is that 1 year, call it to 5 year bucket, and then that 5 year beyond bucket, so that you have a well-rounded financial plan, so that if this continues, or maybe there's a lull of a period in the stock market, you're prepared for whatever's thrown at you. Versus saying, okay, cash feels great, bonds feel great, but inflation keeps going up and you had no money in stocks to help you beat that. Or real estate, other investments, et cetera, that have historically helped to outpace inflation.
Risk assets.
Yeah.
There are
Right.
risk assets that don't have a long-term good rate of return, but stocks and real estate are assets that have a long-term track record of performing, outpacing inflation. And we're in a unique time where inflation was low coming out of 2008. We actually did have a deflationary period there for a moment in time, but inflation was low right around that 2% coming out of the financial crisis. And rates were also right around zero. So it made it a really hard time in the kind of savings fixed income world, because rates were so depressed that any cash that was sitting in the bank, you weren't earning anything. And fixed income was pretty unattractive just because how low rates are. And now we fast forward to where we are now, and it's kind of the opposite environment where inflation's going down. The forecast for rates is to be going down over time, but right now rates are relatively higher, and bond prices are pretty high or bond rates are pretty high compared to where they've been 2 years and prior coming out of the financial crisis. So there's a lot of opportunity if you have the time horizon and if it makes sense for your financial plan to not have as much cash in your portfolio and kind of move into the fixed income conversation. We've been having lots of those conversations with clients, and if you work with us, definitely ask us or talk to your financial advisor about that, because it's really compelling these days. But
and y'all touched on real estate, and usually, I mean, stock market and real estate, two good ways to make money. But right now with interest rates where they are, it's like, I mean, people are probably not getting into real estate as much as they would to beat inflation because of that. I would think it's just hindering it a little bit. And so more people should maybe, or are maybe going to the stock market.
Yeah, it's definitely harder. I mean, if you're, just from a monthly cash flow perspective, if you were able to put, I guess usually, let's talk rental properties. You put 20% down in rental property, and when rates were at 3%, that cash flowed pretty nice. With rates maybe at 6%, that doesn't cash flow as nice. So it all depends. I feel like it all depends on your goals a little bit there, or how much money you had to be able to put down on a property. But then again, money in real estate is made because of the leverage. So yeah, it's definitely harder to make money in real estate right now, but I think there are opportunities out there that can still make sense. And then as rates come down which I feel like the Fed is, all but said with 100% certainty that's going to happen. Like over the next 6, 12, 18 couple of years, probably the end of this year into 2025 and then 2026, I think rates come down, makes real estate look a little bit more attractive. And I think if history shows anything, they end up cutting rates faster than what they have had previously kind of said that they were going to. So maybe things are a little bit more attractive even by mid to late 2025 to where real estate starts to pick back up. Because I do feel like there are probably a lot of people out there who are ready to buy real estate. They're just waiting for rates to come down a little bit. And so I think you could see things pick up when that does happen.
I mean, we've had a lot of people park cash here in the money market fund, just waiting for that too.
Yep. Yeah, I do think real estate is, again, I mean, we're not Nostradamus on this, but I think at some point soon, when rates come down, real estate will kind of take back off again.
It's tough because it's a double-edged sword. One, yes, rates are going to come down, but supply is still lacking, and home prices across the U.S. really haven't moved. They haven't really come down. Obviously, there's pockets here and there, and different cities are impacted differently. But with home prices staying the same, if not still increasing, and interest rates being so high, affordability is just awful. So then just imagine rates come down, supply stays the same, people start buying again. I mean, it's supply and demand, econ 101, where you all of a sudden really add to the demand side. You don't help the supply side as much. It can really start to increase cost again, like we had a couple of years ago. Or another theory is maybe the people who are stuck with a 3% mortgage, maybe they start to really sell again because they can add to the supply, because now they're going to go out and potentially look for another home since rates have come down. But I guess that's still adding to the demand, even if it's adding to the supply. So,
well, and also with rates, if they do come down, I mean, how far do we really expect them to come down? They're never going to go back down to the 2 or 3s, I wouldn't think.
Never say never.
Never say never, right? But say they're at 5.5 even. That's still a big jump from 2.5 to 3 as far as affordability goes. So those new home buyers, young people that are trying to buy houses, they're still going to be stuck for a while, I think.
Yeah. Yeah. I mean, long-term average mortgage rate in the US, what, 7-8%? We're already below that. So people are just spoiled with recency bias with, hearing that people have 2.5-3% mortgages. I personally don't feel like that's going to happen again, or if it does, it's because something really, really bad economically happened to crash rates. So I think, being happy in the 4 to 5% range, even in the 5% range, I think is a great spot to be with a mortgage.
I think there needs to be a resetting of expectations, which I feel like is kind of slowly starting to happen. I feel like you're seeing people are still buying homes. I mean, you are seeing that. But I think
you're not going to see any 30-year-olds buying $1 million homes right now. I don't think, just because of that there, when they could have.
It hurts that. It hurts that person at a 3% rate, depending on cash flow, monthly cash flow. That house was maybe affordable depending on down payment size. But yes, I mean, that person that was maybe able to buy $1 million house at a 3% mortgage is now maybe in the, 6 to 700, 800,000 range.
Yeah, that's right.
So,
I mean, really, moral of the story when it comes to inflation is it's here. We can't do anything about it. Protect yourself by, if you have the extra cash flow, investing in assets that outpace inflation over time, not necessarily in the short term, but over time. And really don't have too much cash just sitting on the sidelines. If goods are increasing, you're arguably better off buying those goods today than you are 2 months from now, because they're just going to be more expensive based on a static inflation line. So, if there's, I don't know if you have anything else to offer, but if there's anything that we can do as far as a financial plan goes, if it's a cash position, looking at fixed income, or just talking to inflation and how that looks on the spending level, that's what we're here for.
Yeah. I feel like this is just good to kind of talk through and plan around. I mean, obviously inflation has been high for the last, call it 3-4 years, but still timely. I think in a lot of meetings that we're having, people are, I'll use the word complaining. Maybe that's not the best word, but just complaining about how expensive they feel like things are. I know we provided a few examples here today. And so to Carson's point, I don't think we're going to see huge price decreases. They're probably just going to grow at a little bit lower rate going forward. And so
buy that quarter-pounder meal today, because it might be more expensive tomorrow.
And I've seen those videos where, like, they're good for 5 years, so you can just kind of put it in your pantry, and it might be good to eat in like a decade from now or something like that.
Disgusting.
So, but no, they're not going down. Hopefully it's at a lower rate as far as prices. But I think, I'll just say this kind of maybe as we end here, but when we're building financial plans for clients. When you build a plan for somebody who's maybe in their 50s and looking to retire in maybe 5 or 10 years, and then you see what their expenses in today's dollars inflated at just a little over 2% look like 25 years from now, the numbers are like so big, sometimes they're almost unbelievable. And so whether it's inflation's at 2% or 9%, the numbers still grow. And so you need to be prepared from a long-term perspective for that and have a plan in place to be able to build upon that and weather that for the future.
Yeah, that's right.
Awesome. Well, thanks for joining us today. Pretty good topic. I think a timely topic, and we're enjoying doing these. So hope you guys continue to join us, and thanks for joining us on the Retire While You Work podcast.
Any opinions are those of myself and not necessarily those of Raymond James. Expressions of opinion are as of this date and are subject to change without notice. The information contained in these podcasts do not purport to be a complete description of the securities market or developments referred to in this material. The information has been obtained from sources considered to be reliable, but we do not guarantee that the foregoing material is accurate or complete. Every investor situation is unique, and you should consider your investment goals, risk tolerance, and time horizon before making any investment. Prior to making an investment decision, please consult with your financial advisor about your individual situation. Any hypothetical examples are for illustration purposes only. Actual investor results will vary. Raymond James does not provide legal or tax services. Please discuss these matters with the appropriate professional.